Tighten until inflation abates or until they break something, and it looks as though they are on the verge of accomplishing one of those two. And it's not inflation, right? The last few weeks have given the banking system a huge amount of stress, and we saw Signature Bank and Silicon Valley Bank succumb to those pressures, and they folded. They're gone. But where does it go from here? It doesn't take a rocket scientist to realize banks are going to be very careful how they run themselves going forward, right? The government facility that was opened up to help the banks saw the banks borrow about $150 billion up until, say, March 15th. That surpassed the $112 billion they borrowed during the great financial crisis of 2008. So it's almost 50% more. So lending standards inevitably will tighten, and the lack of activity because of tightened lending standards leads to a slowdown and then ultimately a recession. Big firms like Amazon and Walmart are taking notice, and last week Walmart announced hundreds of layoffs in 5 of their e-commerce facilities. And so far in 2023, retailers have cut 17,500 jobs. And that compared to this time last year, they only cut 750 jobs. All right. So my next guest has her finger on the pulse. Please welcome to the show, Rebecca Walser, president of Walser Wealth Management. Thank you very much for being on, Rebecca. You know what? Like I said just before we came on, there's still some signs pointing to the fact that we've got problems.
Yeah, I was just looking at this last week, Scott, the banking lending requirements and how much more tight they've already become. Like you can look at the Fed chart. The Fed has a chart, as you know, about banking regulations and tightening of credit. And it's just a straight up line from 2022 to present day. So banks obviously knew that something was coming, and they have tightened their lending requirements, which basically actually exacerbates the problem because it means less liquidity for maybe those marginal groups that would have otherwise qualified if we were in a boom sort of cycle and money was a little bit easier and more free flowing. And so those companies will obviously, and those individuals will obviously get declined now and not have really any other resources, and it could start spawning bankruptcies, you know. So we definitely see a shift now in the analysis, the data analysis. What I really noticed is that the analysis is now sort of saying, I guess what I'm trying to say, Scott, is that I'm starting to see a bigger problem than recession on the horizon or even depression. And that is a global sovereign debt crisis where it like literally we see countries collapse and governments collapse. This is a once in 100-year type of event or even 200 years. And the global nature that we've never really seen before is probably, well, this has never happened before because really China joined the World Trade Organization in 2001. And we really outsourced and became, their purveyor of all of their goods and wares, really since that time. So what I'm seeing now in the data is that the Fed, in order to sort of stop this crisis that is just in the infancy stages, and that's what I'm afraid that people are not understanding, that they're thinking that the government came out with a machete and it cut off the head of this snake and we're going to be fine and we're going to move on like it's 2008 all over again, 2009. And it's just not at all apples to apples. We have already got over $8 trillion on the Fed's balance sheet. So we are not nearly in the same position of strength that we were at 2020 when we could weather that storm, that we were in 2008 when we could weather that 2008, 2009. We are not there anymore, Scott. So what the analysis is now showing is that the Fed needs to cut. They probably need to cut 4 times, and they need to cut very quickly if they want to stop this global sovereign debt crisis that is now going to infiltrate into the banking system. And if the problem is they cannot do that, Scott, because to do that, reverse course and go back to the solution from 2008 and 2020 coronavirus, which is to have very low cost of capital and to stimulate the dickens out of everything globally. That is not a solution this time. That is why we are where we are. So I think that the reason Powell has been so hawkish, even still in this last week, is because of the fact that if he starts to act like he's anything else, like he's going to pivot and reverse course bigly, we're going to have, analysts and bankers and everyone is going to realize there's something fundamentally broken and wrong. And I think that alone could erode the confidence of the dollar. So we are in a really very, very difficult time.
Well, you're right. He was so hawkish that he wouldn't even say that he wanted to pause, right? He thought that would send something of a similar, signal. But you know what, Rebecca, what about inflation? I mean, if they turn around and have to cut, like you say, I mean, we've had 9 hikes in a year, basically, right? Which is pretty unprecedented. I'll give them that. But now that if you want to turn around and cut rates, what happens to PPI and CPI?
I mean, this is the reflection of having a fiat-based currency system. When you untether hard assets to your currency, as we did when we got off the gold standard completely in 71, and then we sort of retethered it to to crude,
right,
with the petrodollar. But yet that tethering has not been strong enough, Scott. It has not been a direct one-on-one relationship, as you know, that it has allowed the investment bankers and all of the money creation engines of the economy to create derivatives, to create all kinds of. I mean, people don't understand how big our derivatives market is either in comparison to 2008 and 2009. They think that we're in a better place because we have all these cancelable derivatives. Like you have on one side one shoulder, and you have on the opposite you have a derivative that's to protect you. But everyone acts like these derivatives cancel each other out. That's not true. Unless you have a direct contract, you're not canceling out losses. You're just assuming that the market is going to just somehow rightfully self-balance. This is a mess. It's a mess,
right.
Scott.
You're right. And I don't know the answer either. That's why I was hoping you had one. But to put it in perspective, to your point, exactly. You raise interest rates 9 times in 1 year. I mean, there's going to be a big knock-on effect, a big shock just because of that. But I did look up how big that OTC, the over-the-counter derivatives market is. It's over $600 trillion. Can you imagine 9 interest rate hikes making waves through the $600 trillion over-the-counter derivatives market? I mean, there are going to be some ramifications, and I think that's what you're trying to say.
I mean, I think what I'm trying to say to people is that economically speaking, it seems like we've reached a point in the creation of money that is not recoverable from, and that it almost looks like now that some kind of collapse is a foregone conclusion. And it makes me wonder if the timing isn't very planned with the launch of multiple currencies of CBDCs this year. And we had the Trilateral Commission, which is one of those globalist organizations, basically say that 2023 was the first year of the New World Order. So I'm just wondering if everyone is aware that this is really a non-recoverable economic situation that we are now in, and that they know that we're moving to a new system, because this is impossible to deal with. Like the economics of this looks impossible to me.
Yeah, it's almost untenable. You're right. I agree. All right. Well, you've really welcomed.
So depressing. I'm sorry.
Well, that's all right. This is only this.